For years, it was believed that the U.S. office real estate market had weathered the post-pandemic shock, that the market had bottomed out and was gradually recovering. That belief ran parallel to another reality: trillions of dollars in debt tied to office buildings will mature between 2026 and 2030, in an interest rate environment vastly different from when those loans were taken out. This issue isn't just about building owners or real estate investors. It directly impacts regional banks, the budgets of major cities, the jobs of millions of office workers, and ultimately, the stability of the U.S. financial system this decade. If you live in the U.S., work in urban centers, deposit money in a local bank, or simply rely on a stable economy to sustain your income, what's happening in the office market isn't a far-fetched story. It is quietly shaping the economic environment you will face in the coming years. In this video, we won't be talking about stock prices, nor looking for a sensational crash day. Instead, the analysis will focus on three key indicators: the debt structure of U.S. office real estate, the refinancing mechanism in the context of persistently high interest rates, and how this risk is spreading from seemingly inanimate buildings to banks, cities, and real-world economic life. Some data has begun to signal a warning. The delinquency rate in the office segment of the securitized commercial real estate market has surged and remained high, even as other segments show signs of greater stability. Many loans signed during a period of near-zero interest rates now face refinancing at significantly higher costs, while the value of the underlying assets has declined. At the same time, the media continues to highlight the bright spots. Some luxury buildings in major cities are signing new leases, some market indicators suggest trading is returning, and reassuring statements that the banking system is better prepared than in previous crises. These two pictures coexist. On one side are the surface signs of recovery. On the other is a mountain of debt nearing maturity, with far more unfavorable financial conditions than in the past. The question isn't whether the office market will collapse, but rather, who will absorb the costs of this adjustment, and how far will it spread throughout the U.S. economy? This is a story about systemic structure, not about individual mistakes. And to understand why this risk is forming, we need to start with the historical context and the initial signals the market is sending. To understand why U.S. office real estate is poised to become a systemic risk factor in the 2026 to 2030 period, it's necessary to look back at the formation of this market structure over the past decade. Following the 2008 global financial crisis, prolonged ultra-loose monetary policy created an unprecedentedly cheap capital environment. Low interest rates, abundant liquidity, and the demand for stable yields made commercial real estate, particularly office space, an attractive channel for both banks and securitized markets. Office buildings were seen as assets with steady cash flow, long-term leases, and relatively low risk. Between 2012 and 2019, the U.S. office market expanded significantly. Major cities witnessed a wave of new construction, renovation, and redevelopment, based on the assumption that demand for workspace would continue to grow alongside economic growth and urbanization. Many loans were structured with high leverage, long maturities, and favorable refinancing conditions, as the cost of capital was then considered the new normal. The COVID-19 pandemic disrupted this model, but did not immediately break it. During 2020 to 2021, massive fiscal and monetary support measures helped the financial system avoid an immediate shock. Interest rates remained very low, and many debts were extended, restructured, or temporarily frozen. On the surface, the office market seemed to be experiencing only a short-term shock. However, it was during this period that a structural shift occurred. Remote work and hybrid models were not just temporary solutions, but gradually became a permanent part of business and employee behavior. The demand for office space hasn't disappeared, but it has become deeply polarized. New buildings, central locations, and high-end amenities remain attractive, while much of the remaining space faces prolonged vacancy rates. By 2022 to 2023, as inflation forced a rapid reversal of monetary policy, the old assumptions began to show their weaknesses. Sharply rising interest rates completely altered the financial dynamics of office real estate. Rental income wasn't growing fast enough to offset higher capital costs, while asset values were adjusted downward due to revaluation based on the new interest rates. Media and numerous market reports for 2024 to 2025 often emphasize that the U.S. economy continues to grow, the labor market is relatively strong, and the banking system is better managed than in the past. Aggregate data shows low unemployment, sustained consumption, and several large office transactions still taking place in key urban areas. These arguments are not wrong, but they reflect an average picture. They do not show the differentiation within the office market, nor do they fully reflect the maturity structure of commercial real estate debt. Much of the risk lies not in the present, but in loans maturing in the near future, concluded in a completely different financial world. By 2026, the market will begin to enter a phase where many office loans can no longer delay refinancing. Indicators of overdue debt and loans requiring special handling have increased, not because of sudden mass bankruptcies, but because the original financing model is no longer suitable for the new interest rate environment and demands. This is an early sign of a long-term, quiet but far-reaching adjustment process. It didn't appear as an immediate collapse, but rather as a gradual buildup of pressure within the credit system, bank balance sheets, and municipal budgets. And to understand why this pressure directly impacts the lives of American citizens, a deeper analysis of the direct and indirect causes behind it is necessary. When office real estate is mentioned as a systemic risk, many people's first reaction is to view it as a problem for property owners or the financial market. But in reality, the underlying causes in this segment are closely tied to the economic lives of Americans in less obvious ways. The most readily identifiable direct cause lies in the mismatch between property income and financing costs. Most office loans were taken out during periods of extremely low interest rates, with the assumption that rental income would be stable or steadily increasing over time. As interest rates rise rapidly, the refinancing costs of these loans increase significantly, while rental income cannot adjust accordingly. Many businesses no longer need as much space as before, and new leases are often shorter and more flexible, meaning less certain cash flow. This decline is not uniform. Some high-end buildings, located in the heart of major cities, still attract tenants willing to pay high prices. However, the majority of the market has to settle for lower rents, more incentives, or prolonged vacancy rates. This creates a two-tiered picture, where average figures mask the plight of the majority of properties. An indirect, but more far-reaching, cause stems from the financial pressures on both office workers and businesses. The real income of many American households has not kept pace with the cost of living in recent years. Inflation, while having cooled from its peak, remains significantly higher than pre-pandemic prices. Rent, healthcare, insurance, and education continue to account for a large proportion of household budgets. In this context, people's economic behavior has shifted towards a defensive stance. Spending is delayed, precautionary saving increases, and risk tolerance decreases. Businesses, particularly small and medium-sized enterprises, SMEs, are responding by tightening cost controls, limiting expansion, and cutting demand for office space. These decisions, when implemented on a large scale, directly undermine the cash flow foundation of the office market. Another often underestimated factor is the overlapping debt pressures in the economy. Workers carry the burden of student debt, consumer debt, and high living costs. Businesses carry rising borrowing costs and uncertain market demand. As both sides scale back activity, office space becomes one of the first expenses to be reconsidered. This doesn't reflect a clear recession, but rather a state of sustained strain. The combination of these factors creates a paradox. On macroeconomic reports, the U.S. economy may still be described as stable or slow but sustained growth. But at the micro level, people don't perceive that stability in their daily lives. They see costs rising faster than incomes, less secure jobs, and less vibrant central cities than before. It is in this gap between aggregate data and real-world experience that the risks in office real estate are nurtured. It doesn't erupt from a single shock, but from millions of survival decisions made simultaneously by households and businesses. When those decisions accumulate long enough, they translate into financial pressure on buildings, loans, and ultimately the underlying credit system. To understand why this pressure isn't limited to the office market but extends to the entire U.S. economy, a closer look at the core elements of the financial and policy structures governing this process is necessary. To understand why office real estate could become a risk conduit in the U.S. economy between 2026 and 2030, we need to look at how the core elements of the financial system interact, rather than considering each variable in isolation. The first factor is the prolonged period of monetary policy being tighter than recently recorded. While inflation has cooled from its peak, interest rates remain significantly higher than during the 2010 to 2021 period. This not only increases the cost of new borrowing but also alters the entire logic of asset valuation. Office buildings, which are valued based on discounted future cash flows, become less attractive as the discount rate increases. Even if nominal cash flows don't decline sharply, the present value of the asset is still adjusted downward. The second factor lies in the financial structure of the commercial real estate market. For many years, risk has been dispersed through securitization, particularly instruments tied to commercial real estate. This mechanism helps the system absorb initial shocks better, but at the same time creates a lag in identifying and processing losses. When office loans become problematic, they don't immediately become a banking problem, but gradually emerge as overdue debt, special handling, and prolonged restructuring. This lag makes the market susceptible to complacency. While macroeconomic indicators remain stable, the real pressure builds in the balance sheets, where asset values and book values increasingly diverge. By the time of maturity, that discrepancy can no longer be concealed, and the adjustment costs must be recorded. The third factor is the structure of the labor market and how it responds to technological and organizational changes. The rise of remote work and hybrid models is not just a cultural trend, but an economic shift. It allows businesses to optimize costs, but at the same time undermines the traditional role of physical office centers. As demand for centralized space decreases, the value of many office buildings no longer justifies the capital costs incurred to build and finance them. Simultaneously, technological advancements and automation are shifting the structure of work toward less reliance on fixed physical space. This doesn't create an immediate shock, but gradually diminishes the long-term demand for office space, especially for assets that cannot be easily converted. A fourth factor is asset inequality and uneven risk absorption within the system. Large asset owners, with access to capital and bargaining power, can delay, restructure, or accept controlled losses. Meanwhile, regional banks, local governments, and small businesses have more limited room for adjustment. When office values decline, the impact is not evenly distributed, but concentrated on the weakest links in the system. Finally, fiscal policy and urban governance play a role in amplifying or mitigating risk. Many cities rely heavily on property taxes, and economic activity revolves around central office districts. When office values and usage decline, local budgets are pressured, forcing adjustments to spending or increasing the financial burden on other sectors of the economy. This process is subtle, but has long-term effects on the quality of public services and the attractiveness of the city. These factors do not operate independently. They intertwine and amplify each other, creating a slow but sustained feedback loop. This chain reaction means that the risks in office real estate cannot be viewed as an isolated issue, but rather as part of a broader picture of structural adjustments in the U.S. economy this decade. When financial pressures build up in the office real estate market, the consequences extend beyond asset values or owner profits. They spread to the real economy through slow, but persistent and irreversible pathways. The first impact appears at the urban level. Central districts, once built around the daily commute, begin to lose their familiar rhythm. Decreased foot traffic leads to reduced revenue for surrounding restaurants, retail stores, transportation services, and entertainment venues. These small businesses, already operating with thin profit margins, can be forced to downsize or close after a prolonged downturn. This alters the economic structure of cities, not through a single shock, but through gradual erosion. For workers, the impact extends beyond the direct risk of job losses in office-related service industries. The weakening of urban centers reduces job opportunities, limits career mobility, and increases feelings of insecurity. Even those who retain stable jobs face a less flexible work environment where businesses prioritize cost-cutting and delay long-term investments. Large businesses are not immune to the impact. As office values decline, previous investments become a burden on their balance sheets. This forces businesses to adjust their strategies, from reducing lease space and restructuring operations to delaying expansion projects. These decisions, when replicated, slow down the pace of investment across the economy. The middle class is affected in less obvious but no less profound ways. The value of assets related to retirement, investment funds, and insurance can be impacted as the commercial real estate market adjusts. Simultaneously, the burden of local taxes and fees risks increasing to offset declining municipal budgets. This further narrows the financial space of households already burdened by high living costs. At the financial system level, the pressure from office real estate poses a risk allocation problem. Regional banks, which play a crucial role in financing small businesses and local communities, must dedicate greater resources to debt management and balance sheet consolidation. This reduces the ability to provide new loans, creating a negative feedback loop between credit and local economic growth. More importantly, these consequences are not uniform. They are unevenly distributed across geography and industry, widening disparities between regions and population groups. Some cities may adapt more quickly through economic diversification, while those heavily reliant on traditional office space face a painful and prolonged adjustment process. Notably, there was no single moment marking the explosion of the crisis. Instead, the consequences for office real estate manifested in a decline in quality of life, reduced economic opportunities, and increased social anxiety. These are signals difficult to measure statistically in the short term, but they have the power to shape people's behavior and expectations for many years. Because of these widespread and insidious impacts, office real estate becomes a crucial link in understanding how financial shocks translate into social problems. And to better understand the depth of the risk, it is necessary to look at aspects often overlooked in common analyses. In most popular analyses, the risks of office real estate are often presented as a technical issue: vacancy rates, asset value depreciation, or the increase in delinquency. This approach overlooks a range of less measurable consequences that determine the depth and duration of the adjustment process. The first often overlooked group is the invisible losers. These aren't large property owners or institutional investors with the ability to hedge against risk, but rather the workers in the ecosystem surrounding the office: service, maintenance, security, transportation, and retail staff. As buildings reduce occupancy, demand for these jobs doesn't disappear immediately, but is gradually reduced hour by hour, shift by shift, and short-term contract by contract. These small changes rarely appear in unemployment statistics, but they directly impact the income and stability of millions of households. Another less discussed aspect is the lag in financial risk. Many office loans don't default abruptly, but rather fall into a state of suspension, being extended, partially restructured, or transferred to special handling for extended periods. On paper, the system remains operational, but resources are locked in inefficient assets. This reduces the ability to allocate capital to higher productivity sectors, prolonging low growth without a formal crisis. Also often overlooked is the impact on urban governance. When office values decline, the city's tax base shrinks. To compensate, local governments may have to adjust taxes, fees, or cut public spending. These decisions directly affect the quality of services such as education, security, and infrastructure, thereby reducing the city's attractiveness to businesses and workers. This cycle is difficult to reverse because it relates to long-term expectations about where to live and work. Another long-term risk, less reflected in short-term data, is the freezing of the conversion process. Converting offices to residential or other purposes is often seen as a solution, but in reality, this process requires significant capital, a flexible legal framework, and a long time frame. During the transition period, many buildings may fall into a state of inefficient use, neither generating economic value nor continuing to put financial pressure on owners and lenders. Furthermore, there is the psychological factor of local financial institutions. Faced with a prolonged portfolio of risky assets, regional banks tend to become more cautious in their lending activities across the board, not just to real estate. This impacts credit for small businesses, startups, and community projects, sectors that rely heavily on local funding. This impact extends far beyond the confines of the office market. Finally, a frequently overlooked factor is the asynchronous nature of the adjustment process. While some regions may adapt quickly through economic diversification or new capital inflows, others will be trapped in a prolonged slump. This disparity exacerbates inequality between cities and regions, creating economic low points that are difficult to recover from for years. It is these less discussed factors that determine why the risks in office real estate are not just a market cycle, but a test of the adaptability of the entire socio-economic system. And as these pressures persist, they gradually transform into a deeper problem, a crisis of confidence and sentiment. When the pressures on office real estate are no longer just a financial market issue, the most profound impact begins to emerge at the psychological economic level. This is the stage where macroeconomic figures, while still reassuring, gradually lose their persuasive power over individuals and businesses. Workers' confidence is eroded primarily through prolonged uncertainty. There isn't a single obvious shock to identify, but a series of small, recurring signals: fewer employees in offices, businesses cutting leased space, familiar services around the workplace disappearing. These changes send a silent message that the old normal will not return. As confidence in long-term stability diminishes, economic behavior begins to shift towards a defensive stance. Households react by delaying major spending decisions. Buying a house, upgrading a car, investing in education, or expanding a personal business are all being considered more carefully. Even if nominal incomes don't decline, the perception of risk leads people to prioritize liquidity and reduce long-term financial commitments. This makes consumer demand more fragile, especially in sectors dependent on future expectations. Businesses, in this context, are also adjusting their strategies cautiously. Instead of investing in expansion, they focus on preserving cash flow, optimizing costs, and maintaining flexibility. Hiring decisions are postponed, long-term projects are reconsidered, and the need for new capital decreases. This sentiment doesn't stem from a specific recession forecast, but from a feeling that the economic environment has entered a less certain phase. The crisis of confidence is also reflected in the relationship between people and institutions. As central cities weaken, people begin to question the effectiveness of urban policies, the financial system's ability to manage risk, and the level of protection they can expect from public institutions. This skepticism doesn't manifest as a violent backlash, but rather as a more cautious attitude, lower expectations, and a reduced willingness to take risks. A crucial element in economics is the role of expectations. When expectations of growth, stability and opportunity diminish, collective behavior can create a negative feedback loop. Reduced spending weakens business revenue, businesses cut investment leading to less stable employment, and this instability further reinforces people's defensive sentiment. In this context, office real estate is not just an indicator, but a symbol of a prolonged shift toward a cautious economic climate. It's noteworthy that this crisis of confidence is not uniform. A segment of the population, particularly those with high wealth and adaptability, may still maintain a sense of security. But for the middle class and the working class dependent on the urban economy, prolonged uncertainty is altering how they perceive the future. This has far-reaching implications for social fabric, from choices of where to live to career decisions. When confidence is eroded in this way, restoring it becomes far more difficult than simply manipulating financial indicators. No single policy tool can quickly reverse the collective sentiment formed over years of quiet adjustment. And it is in this context that the larger question arises: what will the American economy have to accept as the new normal? From the outside, the U.S. office real estate market may not look like a crisis in the traditional sense. There are no massive bankruptcies, no panic in the financial markets, and no specific point to label as a breakdown point. But it is precisely this lack of dramatic signs that makes the adjustment process deeper and more prolonged. The period from 2026 to 2030 presents the U.S. economy with a structural challenge: how to absorb the debt built up in an era of cheap capital, when economic conditions and behavior have fundamentally changed. Refinancing office real estate is not just a technical issue of the credit market, but a test of the adaptability of the financial system, urban governance, and labor market. There is no single scenario for the future. In some areas, the adjustment process may be relatively orderly, through debt restructuring, repurposing, and resource reallocation. In other areas, a heavy reliance on traditional office space can lead to prolonged weakness, altering the economic standing of entire cities for years. This difference reflects a crucial reality: risk is not evenly distributed, and resilience depends heavily on the local economic structure. It is important to note that not all consequences are immediately visible in macroeconomic statistics. An economy may continue to grow at a modest rate, while the quality of growth deteriorates and people's sense of stability continues to erode. In this context, relying solely on composite indicators to assess economic health can lead to incomplete conclusions. Office real estate, in this context, serves as a mirror image. It reflects a shift in how people work, how businesses organize their operations, and how the financial system allocates capital. It also reflects the limitations of older models in the face of a new economic environment where the cost of capital is higher and growth expectations are more cautious. The big question isn't whether the office market will recover in the sense of returning to pre-pandemic levels. The question is how the U.S. economy will redefine its equilibrium in a world where space demand, capital flows, and expectations have shifted. The choices made during this period will shape not only the real estate market, but also urban structures and economic life for decades to come. In an economy driven by expectations, the most important thing may not be avoiding all risks, but rather identifying them soberly and accepting that adjustment is an integral part of the development process. The U.S. office real estate market is entering a phase that is quiet, but full of consequences. And as the buildings remain, the lights still on, but the way they are used and valued has changed. The question remaining for the entire system is, are we seeing the true nature of this shift, or are we simply waiting for a return that will never be the same?